All my drunk friends are rushing to buy this hot new alcohol stock. Killer taste, killer brand, amazing price. I think it could blow up too, but here's the problem. Beyond the hype and the cool vibe, I know nothing about the company. So is this stock going to be the next big win or the fastest way to watch my money vanish while everyone gets drunk? In this video, I'm going to teach you a technique that my mentors taught me. A big shout out to Technofunda and Vivek Mashrani. Is the cheat code which I'm using to see if a stock is going to climb or just flop harder than my drunk stock picking friends. From all the books I've read, there's one thing that these super investors keep hammering on, this one topic: earnings, earnings, earnings. It's simple, right? When the earnings grow, the stock prices follow. Now, most traders and investors, what they do is they bury themselves in the con call reports, the annual reports, and the credit rating reports and just get really confused. It's a burnout, right? So what if there was a shortcut to do this? Because here's the truth, I don't think fundamental analysis has to be that complicated. Think of it like this. Long term, stock rises when the company's earnings keep growing. And in short term, prices swing because of hype, fear, or some news which is coming out. Out here, we want to focus on the healthy reason, the earnings growth. But what drives the earnings growth? So here are 4 powerful factors that drive the earnings growth: sales growth, operating leverage, margin expansion, and debt reduction. If you can spot these triggers and confirm their structural long-term trends, then your job as a fundamental analyst is over. That's it. No overload, no overthinking. Just gotta focus like a hawk on those earnings growth. Alright, let's dive into these parameters a little bit deeper. The first one, sales growth. And this can be split into 2 parts. One is the growth that comes from the existing industry, and the other one is the growth that comes from the new things that the company is doing. So how does sales growth actually happen in our alcohol company? So imagine they're selling 100 bottles of vodka for $10 each. That's $1,000 in sales. Now, if they want sales, it either has to come from selling more bottles or charging a higher price for each bottle. That's simple. Sales grow from volume or price, or ideally both. Now, let's talk about the existing industry. Suppose the alcohol market itself is expanding. More people are getting drunk, more bars are opening, demand is rising, and because of which, naturally, the company is growing. The company grows with the industry. Another angle is market share. If our company makes better vodka than our competitors and wins over their customers, their loss becomes our gain, and the sales rise without the market itself needing to get bigger. And of course, then there's the direct route, raising prices. If a bottle goes from $10 to $12, sales revenue grow even if we are still selling 100 bottles. But growth isn't about what's already there. It also comes from new initiatives the company takes. For example, maybe they launch a new product, like a flavored vodka or a crafted gin. I don't know much in vodka flavors. My point is, they launch a new flavor or something and it's a hit with the customers. Or maybe they step into a new geography. Imagine they've been only selling locally and suddenly Swedish drinkers get a taste of it and they're like, hey, we also want that stuff. Now that's instant sales from growth expansion. And then there's finally the idea of new categories. For example, the company could move into ready to drink cocktails or low alcohol seltzers, whole new segments that add to the growth story. So at the end of the day, sales growth boils down to volume, price, and innovation, either from the market itself or from the company's own push into the new areas. Okay, so we've crossed sales growth, but what if sales stay flat? That's where operating leverage kicks in. Operating leverage, ooh, what a fancy big word. What does it even mean? So imagine our alcohol company. It spends heavily on a factory, brewing machines, and salaries. These are fixed costs. See, making each bottle is kind of cheap because the ingredients and the packaging, which are the variable costs, are small. So if the sales are low, the company struggles because those fixed costs, they still need to be paid. But if the sales rise, most of the extra money turns into profits. Now suppose the company replaces 20-30 staff members, their employees, with a machine. Yeah, with AI taking over and we're already getting doomed, why not put that analogy in, huh? So we can all sleep with good anxiety tonight. Coming back to my point, the staff is fired, the machine comes into the picture, and this machine adds a large fixed cost up front, but it cuts down on the salary costs which are supposed to be paid to the employees for each unit produced, which means the cost of making extra bottle drops, but the company is now more tied to covering that machine's fixed expense. This is where capacity utilization matters. At low utilization, the heavy fixed costs weigh the company down because they're spread over too few bottles. But at high utilization, those same costs are spread thin across many bottles. So nearly every extra sale flows straight into profit, and that's operating leverage in action. Another benefit comes from common expenses. A single factory, distribution network, or marketing budget can support a much larger sales base without rising proportionally. For example, whether the company sells one brand of whiskey or three, the same trucks and sales team might handle delivery. As sales grow, these shared costs don't increase much, so profits expand faster. This kind of efficiency is another way operating leverage works in a company's favor. Now, once operating leverage starts doing its magic, which is squeezing more profit out of every sale, the next big lever is margins, because it's not just about selling more, it's about keeping more from every dollar you make. There's always more room for improvement. And here enters margin expansion, margin improvement, and new higher margin products. Now, margins, that's basically how much the company actually keeps after paying the bills. Or in my case, when I receive my salary every month, how much salary is left after my asshole friends finish drinking on my tab. First, margins can expand when costs fall. Second, margins can improve when efficiency rises. Third, margins can jump significantly when new high margin products are added. So let's dive deeper into this. Margin expansion happens when profits grow faster than sales. For example, when our company negotiates cheaper bottles or buys ingredients in bulks, its cost per bottle falls. The selling price remains the same, but the gap between revenue and cost widens, and that's margin expansion. Then comes margin improvement. It's about making the existing business more efficient. Suppose a company upgrades to energy efficient brewing machines or optimizes its supply chain. The core products out here are the same, but they're produced at a lower cost. Over time, these efficiency gains improve the overall margin. Then comes the new higher margin products, which takes it a step further. Imagine the company launching a premium aged whiskey or craft gin. These products can sell at a much higher price while costing only slightly more to produce. Compared to regular rum or beer, the profit margin on each premium bottle is much greater. By shifting its mix towards these products, the company lifts its average margin and profitability. Now, when studying companies, you can always look at these cool data points and get a picture of how their earnings are growing. Last one is debt reduction. The name evidently clarifies what it means, but let me put it into a story that you'd like. Imagine our alcohol company took a big loan to build its factory and buy brewing machines. In the early years, the large part of profits would go into paying the interest on that debt. This squeezes margins and leaves less cash for shareholders or reinvestments. As the company grows, sells more bottles, and generates steady cash flow, it can start paying down the debt. Debt reduction works like a silent profit booster. Every dollar saved on interest is extra profits that fall straight into the bottom line. For example, if the annual interest falls down from $5 million to $2 million after repayments, that $3 million saving directly increases the net profit, even if the sales remained the same. Over time, with less debt on its books, the company not only improves profitability, but also becomes less risky. Investors reward this with higher valuation because the business is sturdier and less vulnerable to downturns. And that's it. Those are the 4 engines to earnings growth: sales growth, operating leverage, margin expansion, and debt reduction. If you can spot these in a company, you are ahead of most investors. And here's actually what you can do today. Pick your favorite company, open its annual report or the con call report, and just search for these terms. Even better, use AI. Find, download, and upload the relevant documents of the company into ChatGPT, Perplexity, or any of the AI frameworks, and simply ask the AI to highlight sales growth, leverage, margins, and debt. That way you cut through the noise and focus on what really matters. Now listen, I am also still a student at this game just like you. But if we keep practicing and learning together, we'll get sharper at spotting great companies with great potential and grow along the way. And hey, just for the record, there's no alcohol in this bottle. This whole time we have been talking about grape juice.